Today, I'm here to talk about digitalizing for competitive advantage. So we used to talk about, big companies absorbing, taking over small companies, big fish eating little fish. And we don't really discuss that anymore. It's self-evident. But what we have started to discuss as an industry and globally is fast companies overtaking slow companies. Now, we all know the story of the response to the financial crisis. The regulatory burden increased massively, and this ended up squeezing margins, squeezing profits for financial institutions. And there were basically two potential responses to this situation. Some banks decided to cut their costs, they cut their way out, they cut their way to profit, and other banks decided to modernize and to address new markets and try to modernize their way to higher margins. Now, it's a big generalization, but the larger European banks tended to cut, the larger American banks tended to invest. Now we're in this strange situation where, as you can see on the left of this slide, there are a number of banks that appear to be simply too big to fail. 56% of banks have a return on equity lower than their cost of equity. And that has to call into question their long-term financial viability. Now, my contention is that some of these organizations are being held in place by the regulations themselves. This is essentially a regulatory moat that prevents or becomes a significant barrier to new entrants in the market and maintains some of these organizations in their position of having concerning financials, but still being with us. Now, being too big to fail is not the same as being competitive in the marketplace. And those banks that did pursue a strategy of modernization and digitalization didn't see an ever escalating set of costs. As they addressed new markets, they didn't just see the cost of their technology stack exponentially increase. What they found was they had an increased ability to compete. Effectively, they reduced the time it took them to take new products to market for their clients. They could onboard their clients faster. They could provide robust, risk-managed access to new markets quicker. And not only for those banks is their return on equity greater than their cost of equity, which is always a good thing, but in addition, their operating expenses as a percentage of assets has declined, as you can see from the right. So there may be banks still out there that are too big to fail, but they're also becoming too slow to compete, and we're getting into a two-speed race in our industry. So not only has the banking marketplace changed, but the environment in which we sit has changed quite significantly as well. Now, we've already talked about one of those drivers, and it's the regulations. Now, the best way to illustrate this is through an example. So derivatives pricing. This used to be a proprietary calculation, and banks could debate differences of valuation between counterparties. But we now have UMR, the uncleared margin rules. Counterparties are now compelled to trade derivatives through clearing, and where it's not possible to trade through clearing, they have to declare their valuation to the market. And in the event that they and their counterparty have differing opinions on the valuation, both counterparties have to hold punitive collateral to cover that difference. Now, originally this was 30 organizations under UMR. It's now over 1,000 as of last year. So we've moved in this very area from a situation where it was beneficial to hold a proprietary differentiating calculation to an area where standardization actually lowers your cost. This has become a non-differentiating activity because of the regulations that have been imposed. And that's a trend we've seen in a lot of areas. Regulations have reduced the number of domains where a bank can really differentiate itself. Now, while the number of non-differentiating services has increased, there's been another change, and that's at the bottom of the slide, which is the partner ecosystem has expanded. So we'd always be faced with some very straightforward choices. Are we going to build technology in-house, or are we going to buy some licenses? Every so often we would, package up some operations and outsource it to a business process outsourcing organization. But now the options are manifold, right? There are obviously the hyperscalers providing all their cloud services, their platforms as a service, etc. Those companies that were selling us licenses are now often, in the vast majority of cases, selling us subscriptions as software as a service. There are industry utilities. There are options to outsource your entire back office if you want to. So not only are there more non-differentiating areas, but there are more partners to help address those non-differentiating areas. If we could move to the next slide, please. So what this really means is that as technologists in financial services, we have a new mandate, and that is to identify the non-differentiating areas and standardize in those areas through partnership with others, and then to identify the differentiating areas and to apply our focus and our investment there and be innovative in our attempts to differentiate ourselves in the marketplace. So I've got a couple of examples of that up on this slide. On the left-hand side, there's the digital multi-hub. So there are a number of financial institutions that have started to provide digital asset services to their clients. You know, I think Goldman Sachs, Morgan Stanley were among some of the early movers. Standard Chartered, you know, has followed suit along with a number of other organizations. And they're basically providing, you know, Bitcoin, Ethereum trading, et cetera, to their clients. Now, in the very short term, there's a first mover advantage in being one of the early banks to provide that service. But that's going to go away very quickly. And in the long term, this is the provision of digital asset trading is a non-differentiating service. Now, what you do with those digital assets, how you provide them, how you price them, that's differentiating. But the underlying technology that allows you to provide the service is not. So Luxoft is working with a set of clients to build an industry utility. We've got some existing ledger technology, multi-custodian connectivity, etc., combined it with the blockchain technology to basically provide a digital asset multi-hub, lowers the cost of each digital asset transaction. Now, on the other side where you can differentiate, as I mentioned, it's important to be innovative. And so I'd like to introduce you to Alexei. This bald tattooed gentleman is one of our consultants. He shaved his head specifically for this project, and he's wearing an emotive Epoch X device. Now, this is a device which reads brainwaves. And within DXC Luxoft, we're conducting a project with one of our clients to provide access to financial services functionality for people with severe disabilities. So in this particular project, we're designing an interface that allows a user to use facial expressions and brainwave recognition technology to navigate a financial portal. And this is a small example, but it's a fantastic example of something that is socially responsible, it's value add, and it shows how clients who are digitally forward can look to differentiate themselves in the marketplace. So this entire setup is quite interesting, and it's quite an exciting time to be in financial services technology. We have the sort of empirical evidence that digitalization brings competitive advantage. We have the luxury of having fewer areas where we can differentiate so we can be more focused, and a wider ecosystem of partners to help us with those non-differentiating areas. And what this is it's a continuation of the evolving journey of the CTO, where CTOs have a significant responsibility in enabling their businesses to be successful. To paraphrase Jamie Dimon's famous line, it's about banks needing to become technology companies, because the business drivers are the technology drivers. It's delivering value faster, it's enabling business change, it's improving profitability. These are technology concerns, these are CTO concerns. And in order to do that, we need to juggle many dimensions of improvement. We obviously need, you know, those continuous deployment pipelines to deliver products into production faster. We obviously need a foundation of stabilized production services. We need data collection and data analytics tooling so that the decisions can be made driven off real facts and insights. And we need to have agile environment management. And then sitting on top of all of those capabilities, we are then able to leverage commodity platforms for our non-differentiating services and lower the cost per transaction and focus our efforts on building innovative and differentiating features to support our business. Okay, thank you very much, Andrew.